Introduction to multifamily investing. Investing in multifamily properties involves purchasing residential buildings that contain more than one housing unit, such as duplexes, triplexes, or apartment complexes. This investment strategy is highly regarded for its potential to generate consistent income and build long-term wealth. Unlike single-family homes, multifamily properties offer multiple streams of rental income, which can help mitigate risks associated with vacancies. Understanding the fundamentals of this asset class is crucial for any aspiring real estate investor. This guide will equip you with the initial knowledge needed to navigate the complexities and opportunities within multifamily real estate. Multifamily investing appeals to a wide range of investors, from those seeking a steady cash flow to those aiming for significant portfolio growth. The ability to house multiple tenants under one roof provides inherent diversification, reducing the impact of a single tenant's vacancy. Furthermore, these properties often benefit from economies of scale in terms of maintenance and management, making them an attractive option for expanding a real estate portfolio. This course will lay the groundwork for understanding these advantages and preparing for successful ventures. Benefits of multifamily properties. Investing in multifamily properties offers several compelling advantages for real estate investors. One primary benefit is enhanced cash flow, as multiple rental units generate income simultaneously, often exceeding the expenses. This diversified income stream provides a stronger financial cushion compared to single-family rentals. Additionally, multifamily properties typically appreciate in value over time, contributing to significant long-term wealth accumulation. The demand for rental housing remains consistently high, especially in growing urban areas, ensuring a steady tenant pool. Another significant advantage lies in the tax benefits associated with real estate ownership. Investors can take advantage of depreciation, which allows for deductions on property value over its useful life, reducing taxable income. Furthermore, expenses such as mortgage interest, property taxes, insurance, and maintenance costs are often tax-deductible. The ability to leverage financing for larger acquisitions also enables investors to control more valuable assets with less upfront capital, amplifying returns. These combined benefits make multifamily properties a robust investment vehicle. Risks of multifamily investing. While multifamily investing offers numerous benefits, it also comes with inherent risks that investors must understand and mitigate. Vacancy risk is a primary concern. Although diversified across multiple units, a high vacancy rate can significantly impact cash flow and profitability. Property management can be demanding, requiring constant attention to tenant needs, maintenance, and administrative tasks. Poor management can lead to tenant dissatisfaction, increased turnover, and property deterioration. Unexpected maintenance and repair costs can also arise, potentially eroding profits if not adequately budgeted for. Market fluctuations pose another significant risk, as changes in local economic conditions or interest rates can affect property values and rental demand. Over-leveraging or taking on too much debt can make an investment vulnerable to market downturns or rising interest rates, potentially leading to financial distress. Legal and regulatory changes, such as new landlord-tenant laws or zoning restrictions, can also impact an investment's profitability and operational flexibility. Thorough due diligence and conservative financial planning are essential to navigate these potential pitfalls successfully. Types of multifamily properties. Multifamily properties encompass a diverse range of residential buildings, each offering different investment profiles and management complexities. Duplexes, triplexes, and quads are smaller multifamily units, typically housing 2, 3, or 4 families respectively. These properties often appeal to first-time investors due to their relatively lower entry cost and simpler management compared to larger complexes. They can also be owner-occupied, allowing investors to live in one unit while renting out the others, which can help offset mortgage payments and provide valuable hands-on experience. Larger multi-family properties include apartment buildings and complexes, which can range from 5 units to hundreds. These investments require more substantial capital, sophisticated financing, and often professional property management. Apartment buildings offer greater economies of scale, as the cost per unit for maintenance and management can decrease with more units. They also provide significant opportunities for value-add strategies, such as renovations or amenity upgrades, to increase rental income and property value. Understanding these distinctions is crucial for aligning investment goals with the right property type. Market research fundamentals. Effective market research is the cornerstone of successful multi-family property investing. It involves systematically gathering and analyzing information about a specific geographic area to identify promising investment opportunities. Key factors to research include population growth, employment rates, average household income, and local economic stability. A growing population and robust job market typically indicate strong rental demand and potential for rent increases. Understanding these demographic and economic trends helps investors pinpoint areas with high potential for appreciation and consistent cash flow. Furthermore, market research should delve into local rental rates, vacancy rates, and the supply of new housing units. Analyzing comparable properties, comps, that have recently sold or are currently on the market provides crucial insights into property values and competitive pricing. Investors should also investigate local landlord-tenant laws, zoning regulations, and future development plans, as these can significantly impact an investment's viability. Thorough research minimizes risk and maximizes the likelihood of making informed investment decisions. Understanding property valuation. Property valuation is a critical skill for multifamily investors, enabling them to determine a property's true worth and avoid overpaying. Unlike single-family homes, multifamily properties are primarily valued based on their income-generating potential. The income approach to valuation is paramount, focusing on the net operating income, NOI, a property generates. This method considers the property's ability to produce revenue after deducting operating expenses, providing a clear picture of its profitability. Understanding this fundamental shift from comparable sales to income generation is essential for accurate assessment. Several key metrics are used in the income approach, including the capitalization rate, cap rate, gross rent multiplier, GRM, and debt service coverage ratio, DSCR. Each metric offers a different perspective on a property's financial performance and risk profile. While comparable sales, comps, are still considered, their role is secondary to the income-generating capabilities for multifamily assets. Learning to calculate and interpret these metrics accurately will empower investors to make sound acquisition decisions and identify properties with strong investment potential. This section will introduce these concepts in detail. Cap rate explained. The capitalization rate, or cap rate, is a fundamental metric in multifamily property valuation, representing the rate of return on a real estate investment property based on its expected net operating income. It is calculated by dividing the property's net operating income, NOI, by its current market value. A higher cap rate generally indicates a higher potential return on investment, but it can also signify higher risk depending on the market. Investors use the cap rate to quickly compare the relative value of similar income-generating properties in a given market. It provides a snapshot of a property's unleveraged yield. Understanding cap rates is crucial for making informed investment decisions. For example, if a property has an NOI of $50,000 and a market value of $1 million, its cap rate is 5%. This means that for every dollar invested, the property is expected to generate 5 cents in annual income before debt service. Comparing this to other properties in the same area helps investors assess whether a property is priced appropriately. A lower cap rate might suggest a more stable, lower-risk asset or a more competitive market, while a higher cap rate could indicate a distressed property or an emerging market with higher potential, but also higher risk. Gross Rent Multiplier, GRM. The Gross Rent Multiplier, GRM, is another quick valuation metric used in multifamily real estate, particularly for comparing similar properties. It is calculated by dividing the property's purchase price by its annual gross rental income. The GRM indicates how many years it would take for the property's gross rental income to equal its purchase price, ignoring operating expenses. A lower GRM generally suggests a more attractive investment, as it implies a lower purchase price relative to the income generated. This metric is useful for initial screening and comparing properties within the same market. While simple to calculate, the GRM has limitations because it does not account for operating expenses, which can vary significantly between properties. Therefore, it should not be used as the sole basis for investment decisions, but rather as a preliminary screening tool. For instance, two properties might have the same GRM, but one could have much higher operating costs, making it a less profitable investment. Investors typically use GRM in conjunction with other metrics, like the cap rate and NOI, to gain a more comprehensive understanding of a property's financial viability. It serves as a good first filter in a competitive market. Net operating income, NOI. Net operating income, NOI, is a crucial financial metric used to evaluate the profitability of income-generating real estate, particularly multifamily properties. It represents the annual income generated by a property after deducting all operating expenses, but before accounting for debt service, mortgage payments, and income taxes. The formula for NOI is gross rental income plus other income minus operating expenses. This figure provides a clear measure of a property's ability to generate revenue from its operations, independent of how it is financed. It is a key input for calculating the cap rate and is fundamental to an investor's financial analysis. Operating expenses typically include property taxes, insurance, property management fees, utilities if paid by the owner, repairs and maintenance. It is important to exclude capital expenditures, major improvements like a new roof or HVAC system, from NOI calculations, as these are considered long-term investments rather than regular operating costs. A robust NOI indicates a healthy, profitable property, while a low or negative NOI signals potential financial issues. Accurately calculating NOI is paramount for making sound investment decisions and understanding a property's true financial performance. Due diligence process. The due diligence process is a critical phase in multifamily investing, occurring after a purchase agreement is signed but before the deal closes. It involves a comprehensive investigation of the property to verify all material facts and uncover any potential issues or liabilities. This thorough examination protects the investor from unforeseen problems and ensures the property aligns with their investment goals. Key areas of due diligence include reviewing financial records, conducting physical inspections, and examining legal documents. Skipping or rushing this phase can lead to costly mistakes and significant financial losses. During due diligence, investors should meticulously review rent rolls, tenant leases, operating expense statements, and utility bills to confirm the property's income and expense figures. A professional property inspection is essential to assess the structural integrity, mechanical systems, and overall condition of the building. Legal due diligence involves examining title reports, zoning compliance, environmental reports, and any existing litigation or liens against the property. This exhaustive process allows investors to either proceed with confidence, renegotiate terms, or walk away from a deal if significant red flags are discovered, making it an indispensable step. Property inspection essentials. A thorough property inspection is an indispensable part of the due diligence process for multifamily properties. It involves hiring qualified professionals to assess the physical condition of the building, identify any existing defects, and estimate potential future repair costs. This step helps investors understand the true state of the asset they are acquiring, and can uncover hidden issues that might not be apparent during a casual walkthrough. A detailed inspection report provides leverage for renegotiating the purchase price or requesting repairs before closing. Key areas of inspection include the structural integrity of the building, foundation, roof, walls, plumbing systems, electrical systems, HVAC, heating, ventilation, and air conditioning, and the condition of individual units. Inspectors will also examine common areas, parking lots, and landscaping. It is crucial to choose an inspector experienced with multifamily properties, as they possess specialized knowledge of systems and regulations unique to these larger buildings. As findings from a comprehensive inspection are vital for budgeting future capital expenditures and ensuring the long-term viability of the investment. Financial analysis deep dive. A deep dive into financial analysis is crucial for evaluating the potential profitability and risks of a multifamily property investment. This involves creating detailed pro forma statements, which are projections of future income and expenses. These statements help investors visualize the property's financial performance over several years, typically 5 to 10, under various scenarios. Accurate pro forma analysis requires realistic assumptions about rental growth, vacancy rates, operating expenses, and potential capital expenditures. It forms the backbone of any sound investment decision. Cash flow projections are another vital component, forecasting the net cash generated by the property after all expenses, including debt service, are paid. Positive cash flow is essential for a sustainable investment, providing liquidity and covering unexpected costs. Investors also use metrics like cash-on-cash return, which measures the annual pre-tax cash flow against the initial cash invested, and internal rate of return, IRR, which estimates the profitability of potential investments. Sensitivity analysis, which tests how changes in key assumptions impact profitability, further strengthens the financial model. Mastering these analytical tools enables investors to make data-driven decisions and identify truly lucrative opportunities. Financing options for multifamily. Securing appropriate financing is a critical step in acquiring multifamily properties. Various loan products are available, each with distinct terms, eligibility requirements, and advantages. Conventional loans, offered by banks and credit unions, are common for smaller multifamily properties, 2 to 4 units, and typically require a significant down payment and good credit. These loans often have competitive interest rates and flexible repayment schedules, making them a popular choice for many investors. Understanding the nuances of these traditional options is crucial for initial property acquisition. For larger multifamily properties, commercial loans, often from specialized lenders, are more common. Government-backed options like FHA loans can be available for properties up to 4 units, offering lower down payments for owner-occupants. Additionally, Fannie Mae and Freddie Mac offer specific loan programs for multifamily properties known as agency loans, which are attractive for their competitive rates and longer terms. Private lenders and hard money loans also exist for investors who need quick funding or have unique circumstances. Though these typically come with higher interest rates, researching and comparing these diverse financing options is essential to find the best fit for your investment strategy and financial situation. Understanding loan-to-value, LTV. Loan-to-value, LTV, is a crucial financial ratio that lenders use to assess the risk of a mortgage loan. It compares the amount of the loan to the appraised value of the property. The formula is simple: loan amount divided by appraised property value. For instance, if a property is appraised at $1 million and the loan amount is $750,000, the LTV is 75%. Lenders use LTV to determine how much they are willing to lend and at what interest rate, as a higher LTV generally indicates higher risk for the lender. Understanding LTV is essential for investors to anticipate financing terms and requirements. A lower LTV ratio typically means a smaller loan amount relative to the property's value, which translates to a larger down payment from the borrower. This reduces the lender's risk and often results in more favorable loan terms, such as lower interest rates. Conversely, a higher LTV, meaning a smaller down payment, increases the lender's risk, often leading to higher interest rates or additional fees. For multifamily properties, LTV requirements can vary based on the property type, market conditions, and the borrower's financial profile. Investors should aim for an LTV that balances their capital outlay with attractive financing terms, making it a key consideration in the acquisition process. Debt Service Coverage Ratio, DSCR. The Debt Service Coverage Ratio, DSCR, is a crucial metric used by lenders to evaluate a property's ability to cover its mortgage payments from its net operating income. It is calculated by dividing the property's net operating income, NOI, by its annual debt service, principal and interest payments. A DSCR of 1.0 means the property generates just enough income to cover its debt obligations. Lenders typically require a DSCR of 1.20 or higher for multifamily properties, indicating a comfortable cushion to cover payments even if income fluctuates slightly. This ratio is a primary indicator of a property's financial health and an investor's ability to repay the loan. A higher DSCR is generally more favorable to lenders as it signifies a lower risk of default. For investors, understanding and optimizing the DSCR is vital for securing financing and ensuring the long-term viability of their investment. A low DSCR might indicate that the property's income is insufficient to comfortably cover its debt, potentially leading to financial strain during vacancies or unexpected expenses. Investors can improve their DSCR by increasing NOI through rent increases or expense reductions, or by securing more favorable loan terms with lower debt service. This metric directly influences a lender's decision to approve a loan and the terms offered. Building your investment team. Successful multifamily property investing is rarely a solo endeavor. It often requires assembling a competent and trustworthy investment team. This team provides specialized expertise, guidance, and support throughout the entire investment lifecycle, from property acquisition to ongoing management. A knowledgeable real estate agent or broker specializing in multifamily properties is indispensable for identifying suitable deals and navigating the market. Their expertise in local market conditions, property values, and negotiation strategies can significantly impact the success of your investment. Building strong relationships with these professionals is a key step. Other crucial team members include experienced lenders who understand multifamily financing, real estate attorneys to handle legal aspects and ensure compliance, and a reputable property manager if you choose not to self-manage. A qualified accountant or tax advisor is also essential for optimizing tax strategies and ensuring financial accuracy. Additionally, a reliable general contractor and various tradespeople, plumbers, electricians, handymen, are vital for property maintenance and renovations. Each member plays a distinct role, and a cohesive team approach maximizes efficiency and mitigates risks, making the investment journey smoother and more profitable. Property management strategies. Effective property management is paramount to the success and profitability of any multifamily investment. Investors generally have two primary strategies: self-management or hiring a professional property management company. Self-management involves handling all aspects of the property yourself, including tenant screening, rent collection, maintenance, and addressing tenant inquiries. This option can save on management fees and provides direct control over the property, but it requires significant time, effort, and expertise, especially as a portfolio grows. It is often suitable for smaller properties or highly experienced investors. Hiring a professional property management company delegates these responsibilities to experts. These companies typically handle marketing vacancies, thorough tenant screening, lease agreements, rent collection, maintenance coordination, and legal compliance. While this incurs management fees, usually a percentage of gross rents, it frees up the investor's time, reduces stress, and often leads to more efficient operations and higher tenant retention. Professional managers bring industry knowledge, established vendor networks, and experience with landlord-tenant laws. The choice between self-management and professional management depends on the investor's time availability, experience level, property size, and desired level of involvement. Tenant screening best practices. Effective tenant screening is one of the most critical aspects of successful multifamily property management. Thorough screening helps minimize vacancies, reduce the risk of property damage, and ensure a stable, positive living environment for all residents. The goal is to find reliable, responsible tenants who will pay rent on time and care for the property. A robust screening process typically includes several key steps, starting with a comprehensive application form that gathers essential information about prospective tenants. This initial data collection is vital for subsequent background checks. Best practices for tenant screening involve conducting detailed background checks, including credit reports, criminal history checks, and eviction history searches. Verifying employment and income is crucial to ensure tenants can afford the rent, typically requiring income to be at least 3 times the monthly rent. Contacting previous landlords for references provides valuable insights into a tenant's rental history, behavior, and payment habits. It is imperative to conduct all screening processes in compliance with fair housing laws and local regulations to avoid discrimination. A systematic and consistent screening approach protects your investment and fosters a harmonious community. Lease agreements and legalities. A well-drafted lease agreement is the foundation of a successful landlord-tenant relationship and is legally binding. It outlines the rights and responsibilities of both the landlord and the tenant, protecting both parties. Key clauses typically include the rent amount, due date, late fees, lease term, security deposit details, and rules regarding property use and maintenance. A clear and comprehensive lease minimizes misunderstandings and provides a legal framework for resolving disputes. It is essential to use a lease agreement that complies with all federal, state, and local landlord-tenant laws, as these regulations can vary significantly by jurisdiction. Understanding the legalities surrounding lease agreements is crucial for multifamily investors. This includes knowledge of fair housing laws, eviction procedures, tenant privacy rights, and property maintenance obligations. Improperly handled evictions or violations of fair housing laws can lead to costly legal battles and significant penalties. Consulting with a real estate attorney to draft or review your lease agreements ensures compliance and provides robust protection. Regularly updating lease agreements to reflect changes in legislation is also a best practice. A legally sound lease agreement is your primary defense against potential legal issues and ensures a smooth operational flow for your multifamily property. Maintenance and repairs. Effective maintenance and timely repairs are fundamental to preserving the value of multifamily properties and ensuring tenant satisfaction. A well-maintained property attracts and retains quality tenants, justifies higher rental rates, and prevents minor issues from escalating into costly major problems. Establishing a proactive maintenance schedule, including regular inspections of common areas, HVAC systems, plumbing, and electrical components, is essential. This preventative approach helps identify and address potential issues before they become emergencies, saving money and minimizing disruption. Investors should budget adequately for both routine maintenance and unexpected repairs. Creating a network of reliable contractors and handymen is crucial for efficient and cost-effective service. For emergencies, having a clear protocol and readily available contacts ensures prompt resolution, which is vital for tenant safety and satisfaction. Documenting all maintenance requests and repairs is also important for tracking expenses, identifying recurring issues, and providing evidence in case of disputes. Prioritizing maintenance not only protects your investment, but also enhances the living experience for your tenants, fostering a positive reputation for your property. Marketing and vacancy reduction. Effective marketing and proactive vacancy reduction strategies are crucial for maximizing the profitability of multifamily properties. Every day a unit remains vacant represents lost income, directly impacting the property's cash flow. Therefore, it is essential to have a robust marketing plan to attract a steady stream of qualified tenants. This begins with creating compelling property listings that highlight unique features, amenities, and the benefits of the location. High-quality photos and virtual tours are increasingly important for capturing prospective tenants' attention in today's digital age. Marketing channels should be diverse, including online rental platforms, social media, local classifieds, and easen-for-rent signs. Understanding your target tenant demographic helps tailor marketing messages and select the most effective channels. Beyond initial marketing, proactive vacancy reduction involves swift tenant turnover, efficient make-ready processes for vacant units, and fostering strong tenant relationships to encourage renewals. Offering incentives for early lease renewals or tenant referrals can also be effective. A strategic approach to marketing and vacancy reduction ensures consistent occupancy and optimizes rental income, directly contributing to the investment's success. Exit strategies. Having well-defined exit strategies is a critical component of any successful multifamily property investment plan. An exit strategy outlines how an investor intends to divest from a property to realize profits or reallocate capital. This foresight helps maximize returns and provides flexibility in changing market conditions. The most common exit strategy is selling the property, either to another investor or to individual homeowners if units can be sold separately. Timing the sale to coincide with favorable market conditions or after implementing value-add improvements can significantly enhance profitability. Understanding potential buyer pools is also key. Other viable exit strategies include refinancing the property to pull out equity, which can then be used for new investments or other purposes while retaining ownership and cash flow. A 1031 exchange or like-kind exchange allows investors to defer capital gains taxes by reinvesting the proceeds from a sale into another similar investment property, offering significant tax advantages. Converting the property to condominiums and selling individual units can be highly profitable in certain markets, though it involves additional legal and financial complexities. Deciding on the optimal exit strategy requires careful consideration of market conditions, tax implications, and personal financial goals, ensuring a strategic conclusion to the investment cycle. Tax implications and advantages. Investing in multifamily properties offers significant tax implications, many of which are advantageous to investors. One of the most powerful benefits is depreciation, a non-cash expense that allows investors to deduct a portion of the property's value each year over its useful life, reducing taxable income. This deduction can significantly lower an investor's tax liability, even if the property is generating positive cash flow. Understanding how to properly calculate and apply depreciation is crucial for maximizing these tax savings. It is a unique benefit of real estate ownership. Beyond depreciation, investors can deduct various operating expenses, including mortgage interest, property taxes, insurance premiums, maintenance costs, and property management fees. These deductions further reduce the net taxable income generated by the property. When selling a property, investors may face capital gains taxes, but strategies like the 1031 exchange allow for the deferral of these taxes if the proceeds are reinvested into a similar property. Consulting with a qualified tax advisor specializing in real estate is highly recommended to navigate these complex rules, ensure compliance, and fully leverage all available tax advantages to enhance overall investment returns. Scaling your portfolio. Once an investor has successfully acquired and managed their initial multifamily property, the next logical step is often to scale their portfolio. Scaling involves strategically acquiring more properties to increase cash flow, build greater equity, and diversify investments. This process requires a refined understanding of market dynamics, access to capital, and efficient operational systems. Successful scaling often means moving from smaller multifamily units, duplexes, triplexes, to larger apartment complexes, which offer greater economies of scale and higher potential returns. It is a journey of continuous learning and strategic growth. Key strategies for scaling include leveraging existing equity through refinancing to fund new down payments, utilizing the 1031 exchange to defer capital gains and reinvest in larger assets, and forming partnerships with other investors to pool capital and expertise. Developing robust systems for property management, tenant screening, and maintenance becomes even more critical as the portfolio expands. Automation and professional management services can free up time and resources, allowing investors to focus on acquisition and strategic growth. Scaling effectively requires a long-term vision, disciplined execution, and a willingness to adapt to evolving market conditions, ultimately leading to significant wealth creation. Common mistakes to avoid. Beginners in multifamily property investing often make common mistakes that can jeopardize their financial success. One prevalent error is failing to conduct thorough due diligence, leading to unforeseen property issues or inflated valuations. Overpaying for a property, often driven by emotional decisions or inadequate market analysis, is another significant pitfall that can severely impact profitability. Neglecting to properly budget for operating expenses, vacancies, and capital expenditures can result in cash flow shortages and financial strain. These initial missteps can be costly and discouraging for new investors. Poor property management is another frequent mistake, whether through ineffective self-management or hiring an unqualified management company. This can lead to high tenant turnover, property deterioration, and legal issues. Underestimating the time and effort required for active management, even with a professional company, can also be detrimental. Additionally, failing to understand and comply with local landlord-tenant laws can result in costly fines and legal disputes. Learning from these common errors and implementing robust processes from the outset is crucial for building a resilient and profitable multifamily investment portfolio. Key takeaways and next steps. This beginner's guide has provided a comprehensive overview of investing in multifamily properties, covering essential concepts from market research and valuation to financing, due diligence, and property management. Key takeaways include the importance of understanding income-based valuation metrics like NOI and cap rate, the necessity of thorough due diligence, and the strategic advantages of building a strong investment team. Multifamily investing offers significant potential for cash flow, appreciation, and tax benefits, but it also requires diligent management and a clear understanding of associated risks. This foundational knowledge is crucial for making informed decisions. Your next steps should involve continued education, networking with experienced investors, and developing a detailed investment plan. Start by identifying your investment goals, risk tolerance, and available capital. Begin researching specific markets and property types that align with your objectives. Seek out mentors and join local real estate investor associations to gain practical insights and build connections. Remember that successful multifamily investing is a long-term journey that rewards patience, persistence, and continuous learning. Armed with this knowledge, you are now better prepared to embark on your multifamily real estate investment journey with confidence.